Somewhere between 2008 and today, humans stopped running Wall Street. The traders in suits, the shouting, the emotions, the instinct, they were replaced by something colder, something faster, something that never sleeps. Today, 90% of all US trades are made by algorithms, not by human hands, and that was the moment we lost the market. After the 2008 financial crisis, Wall Street changed forever. While humans were panicking, machines were learning. The first firms to adapt, Renaissance Technologies, Two Sigma, Citadel, didn't just survive the crash. They rewrote the playbook. Instead of intuition, they used code. Instead of emotion, they used math. Instead of gut feeling, they used data. Millions of data points per second. And it worked. Renaissance's Medallion Fund became the most profitable fund in history, averaging more than 60% annual returns for decades. Not one human analyst made those decisions. Every trade came from a machine. The truth is, humans didn't lose because we were too slow. We lost because we were too human. A human investor has fear, hope, regret, greed. AI has none of that. It doesn't chase the news. It doesn't care about Elon Musk's tweet. It doesn't feel FOMO when the market rallies or panic when it drops. While humans react, algorithms calculate. They analyze trillions of possibilities in milliseconds, testing, optimizing, adapting. And that's why algorithms win. They don't get tired. They don't need coffee. They don't doubt themselves. Humans trade stories. Machines trade probabilities. Walk into Wall Street today and you'll find fewer traders shouting on the floor and more engineers typing in silence. The new traders aren't brokers. They're data scientists. Their weapons aren't phones. They're algorithms running on servers the size of buildings. Every hedge fund now has a secret weapon. Not a person, but a machine learning model trained on decades of market data. BlackRock uses Aladdin, an AI system that scans over 200 million financial scenarios per day to predict risk and guide trillions in assets. When you invest in an ETF, there's a good chance an algorithm made that decision before you ever saw it. The era of stock pickers is fading. The new kings of finance write code, not reports. For decades, human traders believed their instincts gave them an edge. But in the age of AI, emotion isn't an advantage anymore. It's a liability, because the market isn't human. It's math, and math has no mercy. When machines started learning how we think, they started trading against our weaknesses: fear, greed, overconfidence. Every time you panic sell, every time you chase a hype stock, an algorithm somewhere profits from your mistake. That's not manipulation. That's optimization. Pause. So yes, humans lost the market. But maybe that's not the end of the story, because the smartest investors today aren't trying to beat AI. They're learning to work with it. They use AI to read reports, to find patterns, to calculate risk, to filter emotion out of their decisions. In the same way machines learned from humans, now it's our turn to learn from machines. The future investor isn't the one who trades faster. It's the one who thinks clearer. The market stopped rewarding emotion the moment machines learned to trade without it. In the beginning, machines didn't understand the market. They only followed orders. Buy if it goes up, sell if it goes down. But then, they started to learn. Not from textbooks, not from human teachers, but from us. From every trade, every mistake, every emotional reaction we ever had. That's how AI became an investor. The first generation of trading bots were dumb. They followed rules, not logic. If X, then Y. No creativity, no pattern recognition. Then came the revolution, machine learning. Instead of telling the system what to do, we told it how to learn. AI could now process mountains of data, price charts, headlines, tweets, earnings calls, even satellite images. It didn't read them, it understood them. In probabilities, in correlations, in hidden signals humans could never see. The market stopped being about intuition. It became about training data. By 2015, the smartest funds weren't hiring analysts, they were hiring neuroscientists. Because to beat the market, you had to understand how the brain, both human and artificial, made decisions. AI systems like DeepMind's Alpha and OpenAI's GPT proved one thing: given enough data, a machine can teach itself strategy. And Wall Street noticed. Firms started creating self-learning trading models, AI that could backtest millions of scenarios, find weaknesses in its own predictions, and evolve without human input. It was no longer AI helping humans invest, It was AI teaching itself to invest better than humans ever could. Today's investment AIs don't just read financial reports. They understand tone, context, and emotion. When a CEO sounds nervous in an earnings call, AI picks up the hesitation. When media sentiment shifts overnight, AI senses it before most people even read the news. This is emotional intelligence without emotion. The machine doesn't care what the CEO meant. It only cares about the statistical pattern that usually follows that kind of tone. It doesn't see the story, it sees the signal. That's the real difference between humans and AI investors. Humans search for meaning, machines search for patterns. At some point, AI stopped just observing the market. It started creating it. When algorithms trade with algorithms, you get a market no human truly understands. Flash crashes that happen in milliseconds. Spikes and reversals no analyst can explain. Because they're not reactions to news, they're reactions to each other. We built machines to follow our behavior. Now they're building patterns that we can't follow. It's like the stock market became a digital ecosystem where AIs compete, cooperate, and evolve, invisible to the human eye. And if that sounds like science fiction, it's already happening. We created AI to eliminate our mistakes, but in doing so, we created something that no longer needs us. Yet, paradoxically, the more powerful AI becomes, the more valuable human wisdom becomes. Because data can predict patterns but not purpose. It can see the what, but not always the why. Machines can optimize for returns, but they can't define what wealth means. So maybe the future of investing isn't about human versus machine, but about finding harmony between both. The best investors won't be human, and they won't be AI. They'll be hybrids, humans who can think like machines, and machines that can learn from human philosophy. AI doesn't destroy human investors, it only destroys the ones who refuse to evolve. What happens when your money no longer listens to you, but to the machine that knows you better than you know yourself? Your goals, your fears, your risk tolerance, all turned into data, all optimized by artificial intelligence. The age of the AI wealth manager has already begun. Once you called your financial advisor, he'd listen, calculate, recommend a plan. Now, you open an app, and behind that clean interface sits an AI that analyzes everything. Your spending habits, income flow, credit score, even emotional spending behavior. It doesn't just track your money, it predicts it. If you usually buy stocks after a market rally, the AI learns that impulse. If you panic sell during downturns, it learns that too. Then it adjusts your portfolio not by emotion, but by pattern. You are no longer investing your way, you're investing its way. Today, over $3 trillion is already managed by robo-advisors. Platforms like Betterment, Wealthfront, and Vanguard's digital advisor use AI not to gamble, but to stabilize. They don't chase hype, they rebalance, they diversify, they optimize for tax and risk. To many investors, that sounds like the perfect world. No emotion, no mistakes, no greed. But here's the paradox. When every algorithm follows the same logic, the market becomes predictable. And predictable markets don't last. So AI investors start to learn from each other. They compete, they evolve, and soon they'll make decisions faster than any human regulator can understand. In 2010, a flash crash erased nearly $1 trillion in market value in minutes. No human could react in time, because no human caused it. Since then, the systems have become smarter, safer, but also more complex. If an AI misinterprets a correlation, if it learns the wrong lesson, it could ripple across billions of dollars instantly, and we might not even know why. AI doesn't explain its reasoning, it just acts. So the question isn't, can AI make better investment decisions? It's, can we trust what we no longer understand? When machines handle our money, what's left for humans to do? We become the philosophers of wealth. AI can optimize for returns, but only humans can define the purpose of those returns. It can decide how much to invest, but only we decide why. The new investor won't be someone who outsmarts AI. That's impossible. It'll be someone who thinks beyond it, Someone who understands that money isn't just numbers and patterns, it's power, trust, and time. And in the age of AI, the rarest skill will be judgment. There's a darker side to this revolution. When AI manages your money, who controls its motives? The company? The data owners? The algorithms optimizing for engagement, not well-being? Imagine an AI that learns your psychology so well, it can nudge your financial behavior. Not for your benefit, but for its creator's profit. That's not the future of investing, that's the future of control. Which means the next generation of investors must also become the next generation of ethicists. Here's the truth. AI won't destroy financial freedom, but it will redefine it. In the 20th century, freedom meant owning assets. In the 21st, it will mean owning algorithms. Those who understand and leverage AI will build exponential wealth. Those who ignore it will work for the ones who don't. Visual cue: silhouettes of workers under a giant AI brain glowing above stock tickers. The wealth gap of the future won't be between rich and poor, but between the augmented and the obsolete. AI won't replace investors. It will replace the investors who refuse to learn how to use it.